Ind AS 23 Borrowing Cost. This standard is applicable for accounting borrowing cost. This standard does not apply to actual or imputed cost of equity, including preferred capital not classified as liability. So, Ind AS 23 is not applicable to cost of equity and preference shares which are classified as equity. Example, dividend paid on equity shares, that means equity dividend, cost of issuance of equity shares, cost of preference share capital, which is not classified as a liability as per Ind AS 32, will not be included as borrowing cost within the purview of this standard. The general requirement of this standard is to capitalize directly attributable borrowing cost is not required to be applied to qualifying assets that are measured at fair value. For example, a biological asset accounted for under Ind AS 41. Next, inventories that are manufactured or otherwise produced in larger quantities on a repetitive basis, even if they take a substantial period to get ready for sale. This exemption acknowledges the difficulty both in allocating borrowing cost to such inventories and monitoring those borrowing costs until the inventories are sold. So, Ind AS 23 is not applicable to qualifying assets that are measured at fair value and inventories that are produced in larger quantities on repetitive basis. For them, respect to Ind AS will be applicable. Next, what is borrowing cost? Borrowing cost means interest and other cost incurred in connection with borrowing of funds. Examples of borrowing cost: interest calculated using ERI method as described in Ind AS 109, finance charges on finance lease as per Ind AS 116, exchange differences arising from foreign currency borrowings to the extent treated as adjustment to interest cost. These are the examples of a borrowing cost. Next, qualifying asset. Qualifying asset is an asset that takes substantial period of time to get ready for its intended use or sale. Substantial period. As per Ind AS 23, it does not specify what is substantial period. Hence, it depends upon the judgment to decide whether it is substantial period or not. Examples of qualifying asset. Provided definition of qualifying asset is met: manufacturing plants, power generation facilities, intangible assets, investment properties, bearer plants, etc. The following are not considered as qualifying asset: inventory produced over a short period of time, financial assets like investments, assets ready for their intended use or sale when acquired. These are not considered as qualifying assets. Treatment of borrowing cost. If borrowing cost is directly attributable to acquisition, construction, or production of qualifying asset, it should be capitalized with cost of a qualifying asset. In case of other borrowing cost, they should be recognized as expense in P&L. Borrowing cost eligible for capitalization. Specific borrowing, general borrowing. First one, specific borrowing. When funds are borrowed specifically for the purpose of obtaining a qualifying asset, it is a specific borrowing. Borrowing cost eligible for capitalization equals to actual borrowing cost less investment income on temporary investment of those borrowings. So net borrowing cost should be capitalized. Capitalized means it will be added to cost of qualifying asset. Next, general borrowings. General borrowings means borrowings other than specific borrowings. In this case, qualifying asset is funded from a pool of general borrowings. Borrowing cost eligible for capitalization will be calculated by using following steps. Step number 1, calculate capitalization rate. Capitalization rate equals to weighted average borrowing cost on outstanding borrowings of the entity, excluding specific borrowing cost. Calculate total outstanding borrowing rates. Total outstanding borrowings of the entity during the period, excluding specific borrowings. Step 2, calculation of borrowing cost to be capitalized. That is capitalization rate into expenditures incurred on qualifying asset. Borrowing cost capitalized should not exceed actual borrowing cost incurred. Period of capitalization. Commencement of capitalization. Capitalization commencement should begin when all the conditions are satisfied. There are 3 conditions. Condition number 1, expenditure on qualifying asset has been incurred. Condition number 2, activities that are necessary to prepare the qualifying asset for its intended use or sale have been undertaken. Third one, borrowing cost is incurred. Second condition, activities that are necessary to prepare the qualifying asset for its intended use or sale have been undertaken. Such activities not only includes physical work but also includes technical work, legal and registration work, site preparation, planning, etc. Suspension of capitalization. When capitalization will be suspended? Capitalization should be suspended during extended period if active development is not taking place. If active development is not taking place, capitalization should be suspended. Capitalization is not suspended when a temporary delay which is necessary part of a process of getting an asset ready for its intended use or sale is there. That means in case of temporary delay, capitalization will not be suspended. Cessation of capitalization. Capitalization will be ceased when substantially all the activities necessary to prepare qualifying asset for its intended use or sale are complete. If there are any minor modifications, such as the decoration of a property, are outstanding, this will still indicate that substantially all the activities are complete. When construction of qualifying asset is completed in parts and each part is capable of being used separately, cease capitalization of each part which is completed. Next, exchange difference to be treated as borrowing cost. Exchange difference. Exchange difference is of two types: exchange loss, exchange gain. Exchange loss, it will be treated as borrowing cost. Lower of the following will be the borrowing cost: exchange loss or borrowing cost in functional currency less actual borrowing cost in foreign currency, whichever is lower. Balance exchange loss, if any, will be transferred to P&L account. Exchange gain, there will be no treatment for exchange gain. If exchange loss was treated as an adjustment to interest, that means it is treated as borrowing cost in current year, and in the subsequent year, if there is any exchange gain in respect of same borrowing, deduct the exchange gain from interest to the extent of loss previously treated as interest. Next, dividends payable on shares classified as financial liabilities. An entity might finance its operations in whole or in part by the issue of preference shares, and in some circumstances, these will be classified as financial liabilities as per Ind AS 32. Dividends payable on these instruments would meet the definition of borrowing cost subject to the fulfillment of certain conditions. Next, capitalizing borrowing cost in group financial statements. There may be a situation when the borrowings are taken by one company and the qualifying asset is developed by another company within the same group. It may be appropriate to capitalize interest in the group financial statements on borrowings that appear in the financial statements of a different group entity from that carrying out the development. However, the entity carrying out the development should not capitalize any interest in its own financial statements as it has no borrowings. If, however, the entity has intra-group borrowings, then interest on such borrowings may be capitalized in its own financial statements. Next, cessation of a capitalization for maturing inventories. For maturing inventories, it is something it is sometimes difficult to determine when the period of production ends. That is, when inventories are being sold for sale as opposed to being held to mature. Example, whiskey is matured after 3 years but goes on improving with age for many more years, provided that it is consistent with the entity's business model to hold such items so that they mature further. It would seem acceptable to continue to add borrowing cost to the value of such maturing inventories for as long as it can be demonstrated that the particular item of inventory continues to increase in value solely on account of increasing age rather than because of market fluctuations or inflation. If this cannot be demonstrated, then the inventories should be regarded as held for sale and no further borrowing cost should be capitalized.